Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name is Michael, and this week we'll be covering analog chipmakers and why their capital allocation matters. This week we're continuing our series on semiconductor chips, aka integrated circuits. We previously covered logic and memory integrated circuits, and today we turn to their analog cousins. These chips don't grab the headlines like the latest AI accelerators do, but they are actually far more common. Devices like mobile phones can contain dozens of them, and estimates of the numbers sold each year run into the hundreds of billions. We'll wrap this week's insights up with a look at capital allocation, which, as you may know, is an important factor for companies that spend billions of dollars on R&D and equipment each and every year. But before we dive into that, here's our quote of the week. Some people can do one thing magnificently, like Michelangelo, and others make things like semiconductors or build 747s. That type of work requires legions of people. In order to do things well that can't be done by one person, you must find extraordinary people. Steve Jobs. Now, let's dive into what happened in markets this past week. Here's a quick summary of what's been going on. First up, big banks' earnings show signs of consumer slowdown, and this story was from AP News. What's our take on it? After 2 years of banks benefiting from higher interest rates, we're starting to see that consumers are reaching their limits in this environment. Provisions for bad loans, rising delinquencies, reduction in loan growth, sluggish growth on credit card spending, and adjusted profits falling are all signs that consumers are reducing their spending or struggling with their repayments. Chris Stanley, a banking industry practice lead at Moody's, said, "Higher for longer interest rates, persistently high housing prices, softening used vehicle values, and signs of a cooling labour market merit focused scrutiny on the banking sector." While interest rate cuts may be on the horizon, which we'll cover in a second, that may not be enough to encourage consumer confidence or help their financial situations, especially since banks typically don't pass on the cuts to consumers immediately. Next up, slowing US inflation boosts chance of a rate cut, and that was from S&P Global. What's our take on this news? The market is placing high odds on a rate cut in September thanks to inflation heading in the right direction. Inflation for the year to June 2024 came in at 3%, the lowest annual level since March 2021. This, combined with the weakness in the labour market we mentioned last week, provides the Federal Reserve with enough justification to start cutting rates. According to CME FedWatch tool, the odds of 3 rate cuts by year end were sitting at 50% on July 11th. Those who believe we won't see rate cuts in November or December say that the Fed won't want to spook the market, plus it's around election time and employment data hasn't broken into, quote, recession territory yet to justify more than one rate cut for now. Next up, revenue from AI investments may not arrive soon, and this story was from Axios. What's our take on it? The promise of increased revenues from all this AI investment may take longer to arrive than the market expects. Reports from Goldman Sachs, Barclays, and Sequoia Capital have cautioned investors on their current optimism by running some numbers. While companies, in aggregate, are investing hundreds of billions of dollars into AI infrastructure, the segment's biggest revenue generator is from OpenAI, and they are only generating $3.4 billion in revenue annually. David Kahn from Sequoia believes that in order to cover their cost of energy and their margins, companies will need to generate 4 times in revenue what they've spent on NVIDIA data centers, which seems incredibly difficult, at least in the medium term. Axios argues the situation we may have here could be similar to the 2000 to 2002 period where telecom capacity was overbuilt, lots of investors were then wiped out, but within a few years, that capacity and more were all used. Investors seem split on this, and your opinion will dictate whether you think today's valuations are justified. Next up, chip stocks take a beating after comments from Biden administration and Trump, and this story was from Reuters. What's our take on the news? The semiconductor industry suffered a triple whammy last week. Firstly, ASML delivered strong results, but the guidance wasn't good enough for the market. It was then reported that the Biden administration is considering another round of restrictions on exports of advanced technology to China. Finally, Donald Trump suggests that Taiwan should pay the US for defense. Given all those comments and the fact that big tech reports next week, it isn't too surprising that investors decided to take some profits off the table. As US electioneering heats up, there's likely to be a lot more rhetoric. Some of it may eventually find its way into policy, but for now, it's mostly just talk. What matters for the semiconductor industry is the underlying business fundamentals and trends. This type of rhetoric has been going on for a long time, and there are already export curbs in place, and last time we checked, the chip makers were doing okay. Next up, from Business Standard, Google wants to acquire cybersecurity company Wiz for $23 billion. What's our take on it? A better cybersecurity offering may help set Google apart from Azure and AWS. Intelligence analysts have said that there is a hot market for cloud security, given large organizations are a big target for hackers. Global deal-making in the first 6 months of 2024 for cybersecurity businesses has picked up significantly, reaching 137 deals worth $12.4 billion in total, compared to 124 deals worth $4.8 billion over the whole year of 2023. The cloud security industry is reportedly the most important and fastest growing part of cybersecurity, and there's plenty of revenue to gain from it. The likes of CrowdStrike, Palo Alto Networks, Zscaler, Fortinet, others, and now possibly Google, if the regulators let this acquisition go ahead of course, are well positioned to benefit from this trend. Next up, from Reuters, the CCP's third plenum could bring more reforms. What's our take on this news? Expect to see policy changes and reforms that aim to tackle short-term challenges while driving long-term plans. Policy advisors have said that this third plenum will outline efforts to promote advanced manufacturing, revise the tax system to curb debt risks, manage a vast property crisis, boost domestic consumption, and revitalize the private sector. A policy advisor noted that while reforms are clearly needed, they will be complicated to implement because an aging population, property bubbles, local government debt risks, and financial risks require conflicting actions. While the meeting might end with a long list of reforms, some economists believe that the post-plenum statement will likely be light on in regards to implementation and prioritization, or how tensions between reforms will be addressed. And lastly, from the Financial Times, the UK is not planning to follow Europe with tariffs on Chinese imports. What's our take on this news? The British car industry seems content with the state of the local UK car market competition, at least they are for now. In order for the UK government to actually launch a probe and potentially introduce tariffs, as the Europeans have, they'd need the British car sector to formally ask the Trade Remedies Authority to launch an investigation, but they haven't yet. That's not to say they never will, though. The UK exported 700,000 cars in 2023 from brands like Jaguar Land Rover, Mini, and Nissan, and only 7% of them went to China, while 60% went to Europe. This suggests that if the UK did impose tariffs on Chinese-made EVs, they'd be less exposed to retaliation from Beijing than their European counterparts, like Germany, who export a greater portion of their vehicles to China. For now, it seems like the UK's domestic EV market will continue to be dominated by brands that manufacture in China, like Tesla, BMW, and MG, but the UK will, quote, remain vigilant. Now, let's dive into the main piece. The importance of analog and power semiconductors. The types of integrated circuits that broadly fall within the analog category act as a link between the real world and the digital world. Where digital signals are binary and must have a value of 0 or 1, analog signals are continuous and can have any value between a minimum and a maximum. Analog signals represent the level of things like voltage, temperature, sound, and radio wave frequencies. Memory and logic chips process digital signals or data. Analog integrated circuits collect, process, amplify, convert, filter, and transmit analog signals. This category can be further divided into the following. 1. General analog integrated circuits. These include sensors and chips that amplify or transmit signals. These are found in older microphones and audio speakers. The 555 timer IC is said to be the most common chip in the world, with over 1 billion being sold each year. 2. Power integrated circuits. These are used to manage power in systems ranging from mobile phones to the most advanced AI accelerators. And 3. Mixed signal ICs. These process analog and digital signals, typically by converting one to the other. Many of the communication ICs we mentioned last week are actually mixed signal chips. Communication protocols like 5G, Wi-Fi, and Bluetooth rely on these chips. The companies that make these products generally have a large catalog of products that they sell to numerous industries. Unlike the logic market, quite a few analog companies manufacture their own chips. Some analog integrated circuits are very advanced, while others are made using quite dated technology and are relatively inexpensive. However, tens of billions of these chips are used to manufacture billions of devices, appliances, vehicles, and machines each year. Now let's talk about what analog semiconductor companies sell. Texas Instruments and Analog Devices are the largest suppliers of analog chips, and together they account for nearly 40% of the market. Numerous other companies specialize in one or two niche areas of the market. Texas Instruments is arguably the world's first chip maker and was responsible for the first integrated circuit and the first handheld calculator. The company has also been credited with major innovations in computer vision and audio processing. Texas Instruments sells a vast array of sensors, analog and power management chips, and microcontrollers. Their products are used by just about every industry, and chances are you are surrounded by them right now. The company Analog Devices is notable for some of the most advanced mixed-signal chips, including those used for image stabilization in cameras and touchscreen controls. The company differentiates itself by selling complete systems rather than individual components. One interesting thing to note is that ADI's chips are widely used in healthcare technology. Some of the other notable analog companies are Himax and Universal Display, which design and manufacture display driver ICs and display screen technology. Infineon, ST Microelectronics, and Microchip Technology, which we mentioned last week, also sell analog and power ICs alongside their processors and microcontrollers. Skyworks Solutions and Qorvo also supply mixed-signal ICs to the wireless communication industry. The table below includes the largest analog, mixed-signal, and power integrated circuit companies as measured by 2023 revenue. Now let's talk about how analog power chips help us push the limits of innovation. Power management has been a crucial ingredient in the evolution of smartphones and notebook computers. Without power management integrated circuits, we wouldn't have devices that get more powerful and smaller each year. Power integrated circuits have also played a key role in cloud computing, AI, electric vehicles, and the electrification of the economy. The following companies operate in this space. 1. NXP Semiconductors. This company has managed to entrench itself in several industries, from autos to mobile technology and security systems. NXP supplies the NFC chips that allow mobile phone card payments. The company is also a major supplier of power control and management systems used in vehicles and appliances. 2. Monolithic Power Systems. Monolithic provides power conversion and management components used in data centers, telecom infrastructure, and vehicles. The company has been a major beneficiary of the growth in data center capacity. As a result, Monolithic has recorded the highest revenue growth, 46% per year, amongst analog chip makers over the past 5 years. And 3. onsemi. onsemi is a leading supplier to the EV industry. It's a leader in its silicon carbide semiconductors, which improves charging times and range for EVs. The company benefited from the growth in EV sales from 2020 to 2023, but lost momentum when the EV sales slowed down. So, what's the insight here? Wise capital allocation can compound earnings. Everyone loves a bit of profit, and profit margins are the most commonly cited profitability metrics for companies. The gross, operating, and net margins reflect the percentage of revenue that makes it to each stage of the income statement. These margins are important, but they don't tell us the full story. Investors also need to know how effectively a company is deploying its resources. A company can spend its cash reserves and retained earnings in numerous ways. It can 1. Reinvest in the business if there are appealing opportunities. This includes capital expenditures, research and development, and marketing efforts. The business would ideally pick these options if it has investment opportunities that will generate a return above the cost of capital. 2. It can pay down its existing obligations. If the company has a high level of debt, it might be wise to reduce its amount of leverage by paying off some of its debt. And lastly, it can reward shareholders by returning capital to them. This involves paying dividends or share buybacks when the company has enough capital for all of its internal needs and any upcoming expenses, or there aren't any appealing internal reinvestment opportunities for the company. These actions also apply to any new capital raised via debt or share sales. This is where ratios like return on equity, also known as ROE, come in. Return on equity and similar ratios reflect the performance of the underlying business and how good the leadership is at deciding where to allocate capital. If capital is invested wisely, it generates a profit that can be reinvested to generate more profits. This is how successful businesses compound their earnings over time. If a company can't earn a decent return on new investments, shareholders are better off having the capital returned to them in the form of dividends or share buybacks if they make sense in that market. Simply Wall Street's company reports include the return on equity in Section 3, which covers past performance. The return on assets, ROA, and return on capital employed, ROCE, are also shown to provide further context. The images above reflect these ratios for Texas Instruments over the last 12 months. Return on equity is equal to net income divided by shareholders' equity. The return on equity tells us how much profit is generated as a percentage of equity. Equity in turn is equal to assets minus liabilities. This is a good general, but doesn't tell us how much leverage the company is using to generate that return. Return on assets is equal to net income minus net interest expense divided by total assets. Return on assets considers the return on the company's assets. This is useful when comparing similar companies as it strips out the effect of leverage. By comparing the return on assets and return on equity, you can see how much the return on equity benefits from the use of debt. Return on capital employed is equal to earnings before interest and taxes divided by total assets minus current liabilities. Return on capital employed considers EBIT, or earnings before interest and taxes, or operating profit, as a percentage of capital employed. Capital employed is calculated by subtracting current liabilities, which are typically related to operating expenses, from total assets. This ratio tells us how much operating profit the company is earning for every dollar of capital invested. These ratios change over time, and the more cyclical a business is, the more likely they are to change. To get an idea of how well a company uses its resources over the long term, you can look at a 10-year average, which includes several cycles. The table below reflects the average return on equity and return on assets for leading chipmakers over the last 10 years. The company report for each stock also includes the estimated return on equity in 3 years' time in Section 2, Future Growth. This is an estimate based on the average analyst earnings forecast. When you use the stock screener, you can rank the results you get according to these future return on equity estimates, which can give a very different perspective on a company's valuation and expected growth rates. Here, we've prepared a screener to filter for global semiconductor stocks with good returns on equity, and we've ordered it by the 3-year return on equity estimate. You can find a link to the screener in the article. You'll notice that some of these companies aren't chipmakers, but they're companies that supply equipment to the industry. In fact, 6 of the top 10 are these kind of companies. We'll be covering those stocks next week, so keep an eye out for next week's market insights. Now, let's wrap up with the key events during next week. On Wednesday, the Bank of Canada will announce its interest rate decision and is expected to keep rates at 4.75%. On Thursday, US GDP estimates for the second quarter will be released. This is the first estimate and is forecast to be 2.5%, up from 1.4% in the first quarter. US durable goods orders are forecast to have been 2.1% higher in June, compared to a 0.1% increase in May. On Friday, US core PCE price and personal spending data will be published. The price index is forecast to be 2.6% higher over the last 12 months and 0.2% higher month on month. The University of Michigan Consumer Sentiment Index is expected to show sentiment falling from 68.2 to 66. Lastly, it's a big week for earnings season as 3 of the Magnificent 7 report second quarter earnings, with another 3 reporting next week. The largest companies reporting include Alphabet, Tesla, Visa, AbbVie, Qualcomm, Thermo Fisher, Danaher, Texas Instruments, Verizon, IBM, GE, Cadence Design Systems, and NXP Semiconductors. That's all for this week's Market Insights. Thank you so much for listening, and until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.